Hello and welcome to Morning Brief Market Sunrise. I'm Ramzan Karamali, live from Yahoo Finance's studios in London. It's Friday, 1st August. Coming up on the show, it's trade deadline day and President Trump announced sweeping tariffs hitting the likes of Canada, Taiwan and Switzerland. We had more big tech earnings overnight. Both Apple and Amazon beat expectations, but one saw their share price tumble. And we have the details of an IPO that has flown out of the door. So grab your coffee and let's own the morning. Well, the first thing to know before the opening bell rings is that markets are looking deep in the red before the opening bell. Just take a look at this. All three main indices really deep down there in the red. And it was a similar picture in Asia and Europe. President Trump's sweeping import tariffs have raised concerns about the outlook for economic growth. Questions about the impact on growth and inflation are starting to overshadow the AI-driven optimism that has buoyed mega-cap technology stocks. Crucial exporters to the US, such as Taiwan, the world's most important semiconductor exporter, will incur steep new levies. Trump also raised tariffs on Canada, an ally and major trading partner, to 35%, and Switzerland was hit with a levy of 39%. The US president announced this latest executive order on Thursday. He said that tariffs were designed to reduce America's trade deficit with many countries. According to the order, the tariffs would also raise US revenue that would reflect President Trump's plan to use duties on imports to pay for deep domestic tax cuts. Now, the new regime marks a softening of the aggressive levies the president announced on Liberation Day back in April, but still leaves the US's effective tariff rate at its highest level in decades. Trump's move certainly turns up the volume on a trade war between long-standing allies that until this year had enjoyed mostly tariff-free trade since the 1980s. Take Canada, for example. The US bought around $475 billion of goods and services from its neighbour last year, while exporting more than $440 billion to Canada, led by vehicles, auto parts and consumer products. While Trump's new rates provide some certainty to manufacturers, plenty of tariff uncertainty remains. The US president is expected to unveil separate tariffs on imports of pharmaceuticals, semiconductors, critical minerals and other key industrial products in the coming weeks. Now, the market's attention will soon turn to today's jobs report for July, out at 8:30 a.m. Eastern, which is forecast to show that companies are becoming more deliberate in their hiring. Employment likely moderated after a June increase, while the unemployment rate is seen ticking up to 4.2%. The data's release will come as investors closely watch for any further signs of slowing in the US labour market amid growing debate over when the Federal Reserve will cut interest rates next. That's something my colleague Julie Hyman talked about with Morgan Stanley's chief economist, Seth Carpenter, who also looked at the impact of tariffs.
We tried to do a bunch of work looking at what happened in 2018, for example, looking at everything we can scrounge from, looking at changes in prices for supply chains. Looks like in a macro sense, it's about 3-4 months after tariffs get implemented that you start to see it in the inflation data. And then it's probably 2, maybe 3 quarters until you start to see the effects of tariffs pushing down economic growth. If you remember back in 2018, when President Trump was president before, tariffs on China were imposed. The second half of 2018, we saw some disruption to manufacturing because 2/3 of what we import from China are either capital goods or intermediate goods that go into manufacturing in the US. So the tariffs are just taxes on US manufacturing. We saw manufacturing industrial production start to fall in the second half of 2018 and keep falling for 2019. So where are we this time around? Well, we know that we just got some inflation data for the month of June, and it looks like most of the tariff-sensitive categories started to show that pickup. So that's kind of that 3 or 4 month lag that we had in mind. So we expect the inflation data to keep showing increases in tariff-sensitive categories for the next several months, really pushing up inflation for the third quarter quite notably. And then, the fourth quarter, we're probably going to see a big drag on the economy coming in from tariffs, augmented by the drag that the immigration restriction is doing. So we're seeing everything play out in the data now as we had anticipated.
And so, Seth, that implies that people on the street who are waiting for the Fed to cut rates, they might be disappointed for a while, not to mention the president himself.
Yeah, I think that's right. Our base case, once we had the announcement of tariffs coming in faster, bigger, sooner than we had originally thought, they all came in really aggressively in the beginning of the year. we changed our forecast. We said if that's the way it's going to work out, the Fed probably won't cut rates at all this year in 2025. The logic being, and it's very consonant with what Chair Powell said yesterday, inflation is still above target and the labor market for now is just fine. And so there's no reason for the Fed to cut in that circumstance. If inflation goes higher from here, well, that gives them all that more reason to stay where they are with policy, slightly restrictive. And even if and when we start to see some degradation in the economy, some slowdown in the labor market, if inflation is still now high and rising at that point, the bar for them to cut rates has got to get worse as long as inflation is rising. So that's how we get to the idea that they're probably not going to cut rates this year.
Let's now take a look at some stocks that are buzzing this morning. First up, Reddit. It soared more than 17% after the bell on Thursday as the social media platform reported second quarter revenue that surpassed Wall Street's expectations, up 14% in pre-market now. The social platform said its revenue grew 78% to $500 million, its fastest revenue growth in 3 years. Reddit highlighted a growth in active users and said that there's growing interest for its AI search tool. Next up, Coinbase, and the crypto exchange is nosediving this morning with shares down more than 11% in the pre-market. The reason for the fall is likely Coinbase's reported drop in adjusted profit for the second quarter as gains in subscription revenue and services revenue were offset by softer trading activity. And one more trending ticker today that's actually more of a trending sector. Pharmaceutical companies are in the red this morning. As you can see here, industry giants including Europe's Novo Nordisk, Sanofi and Merck all tumbled following President Trump's letters to CEOs in the industry asking them to cut drug prices. Trump's call addressed to 17 drug makers were the latest setback for a sector that's expected to be hit particularly hard by tariffs. OK, it's time for a quick break. We'll be back with an interview with the CEO of the London Stock Exchange Group for an insider perspective on the global race for listings. Welcome back. We are going to talk about IPOs. So this week, an IPO hit the market, and it's fair to say it was a roaring success. Design software maker Figma saw its shares soar 250% on its market debut after an upsized IPO that is likely to trigger a flurry of deals for venture capital-backed startups that have waited for years to list. And it looks like the shares will open even higher once the opening bell rings later this morning. The US IPO market has improved over the second quarter. According to S&P Global, there have been 59 offerings raising $15 billion. That's up from 45 offerings that raised $11.2 billion in Q1. But another major centre, London, well, the story's not so bright. Fundraising from new listings has fallen to a 30-year low. The London Stock Exchange Group revealed better than expected earnings on Thursday, but the market still didn't like what they heard. Shares fell sharply, as you can see, and continue to do so this morning. I managed to catch up with the CEO of LSEG, as it's better known, for his reaction to their earnings and whether London can still remain competitive when it comes to attracting new listings. Now, you've just released results which beat market expectations and a $1.3 billion share buyback as well. What's behind this performance?
So very strong first half, 8.7% top line growth, and significant operating margin improvement, which is something we've been working on, really driving efficiency throughout the business. We have had good growth across all of the different businesses that I just ran through. And just a moment on our business model. We have roughly 70% of our business that is recurring subscription style revenue. So very sticky, very stable, and growing attractively. And then we also see roughly 30% of our business as market related or exposed to transaction volumes. And when you see the kind of volatility that you've seen in the first half, we tend to get the benefit from that as well. It doesn't matter if the markets are going up or down. It's when there's activity, volume, transactions, repositioning. Because of the nature of our markets businesses, we see those flows and we see that activity. So a very robust, strong business model with that subscription revenue that's growing well, and then the revenue that's associated with the market. So we refer to our business model as an all-weather model because it tends to work in all environments.
But so far, since the release of your results, the markets haven't quite liked what they've heard, though. The stock is down, I think, around 7% as we speak right now. Why do you think that is? Is there an issue perhaps with growth?
So we have a metric that we call annualized subscription value growth. And we track that. And when we put that out for this half year, it's down a little bit. And we've talked about what that is driven by. And we have had a very modest number of cancellations and a couple other things in the second quarter that took that down a little bit. And over the last few years, it's been going up, 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 up. And so I think the market is looking at that. We have always told the market that they shouldn't focus too much on this metric because it's very sensitive. We see our sales pipeline growing. We see lots of new product coming to market. The business is doing very well across all of our different businesses. So we have a lot of confidence in the direction of travel for this business. But there's a little bit of sensitivity around that.
Let's focus a bit more on the business that perhaps most people know you for, the London Stock Exchange itself. It's fair to say that you're struggling to attract companies. I think the number of listings is at a 30-year low. Why do you think that is?
I think a couple things around this. First of all, the number of listings on a global basis has declined. And if you look in New York, for example, the number of listings is down by 40% over the last, I don't know what the right time, 10 years or so. Listings in other geographic centers have been a real challenge. And that, I think, is in part due to the geopolitical environment over the last several years. It's also because of the availability of private capital. And you can grow into a very large company fully on the backing of private capital. And that has been just a major driver of growth for companies, really going back the last 15 years or so. On top of that, we have had a lot of changes in the UK over the last several years in terms of modernizing and reforming the listings regime here. To be fair, if you go back a few years, there were some rules that were probably overly conservative, that hadn't really moved along with how markets were operating around the world. And these related to things like dual-class share structures. There were approaches to having a very high free float requirement, where if companies could become very large companies because of the availability of private capital, and then when they go public, you tell them they have to have a very large free float, that doesn't make a lot of sense. So we've changed those kinds of things, and we have changed, for example, some of the conditions in terms of getting into the FTSE index, all these different aspects have been viewed as very attractive and helpful. So we are now actually seeing a growing pipeline and a growing number of companies looking to list here, including as soon as next week. So that has been a bit of a challenge over the last few years, getting much better.
But New York has seen a surge in listings in 2025. Recently we found out that the UK online payment company Wise is moving its listing from London to New York. How can you compete globally against these other big houses?
So there are many companies where it does not make sense for them to list or go to New York.
And but Wise is a UK online payment
Sure,
company.
but let me just give you a couple of statistics around this, because over the last 10 years, 20 companies or so have gone from the UK and listed in New York and raised over 100 million. Okay, of that 20, 3 of them, their stock is trading up. Okay, of the rest, I think something like 8 of them have delisted. I'm going to get my numbers off a little bit here, and I think of the remainder, they're trading down like 70% or so. So I mention that because it's not always worked out very well for the majority of companies that have gone to do that. Another aspect of some of the challenges of going to New York, a lot of companies, if they're not above a certain size and have I'll say a particularly hot story, they get lost in the U.S. capital markets in New York. They don't get the right attention from investors, from research analysts. And so we've had conversations with companies like that who are actually looking for an environment where they will get the appropriate attention from investors. So is it a great market for some companies? Absolutely. But there are many companies where it makes much more sense to be listed and trading in the UK. And I should just remind you, the London Stock Exchange is by far the leading capital center and stock exchange for Europe. which is a very large economic area. There are a lot of other exchanges in Europe. They're not even close to the London Stock Exchange, and it is also the most international financial center. We get capital from the US, from the UK, from the EU, from the Middle East, from Asia. So in all of those respects, it's actually working very well.
Well, we'll be watching those IPOs here in London on Yahoo Finance. Okay, time for a short break, but when we're back, we'll focus on big tech and big energy. Well, welcome back. Time for our market movers, and Apple and Amazon are certainly in the spotlight today after reporting earnings. Let's start with Apple. The iPhone maker posted its fastest quarterly revenue result in more than 3 years, and that's thanks to growing demand in China. As you can see here, investors have been reacting positively. Revenue rose 9.6% to $94 billion in the fiscal third quarter, definitely beating analyst expectations of around $89 billion and forecasting strong revenue growth for this quarter. It's hard to know whether this is really a comeback for Apple in China or whether customers in foreign markets are stockpiling iPhones ahead of tariff-related price hikes. In any case, the elephant in the room for Apple is artificial intelligence. CEO Tim Cook signaled yesterday that the company was ready to spend more to catch up with rivals in AI, to build more data centers and possibly buying some startups in this space. Now, another giant stock that sent shockwaves through markets was Amazon. Yesterday, we saw the stock rally on investor optimism, but that definitely deflated after the earnings release after the bell. Shares fell more than 8% at one point, now just below 8% in pre-market trading after its cloud unit, AWS, failed to live up to the hype built up by rivals Google and Microsoft. To be clear, Amazon beat the top and bottom lines and offered better than anticipated guidance of $174 to $179.5 billion. But its AWS guidance for operating income came in lower than expected. Meanwhile, Microsoft surpassed a $4 trillion valuation after surpassing expectations. So basically, Wall Street seems to think that while Amazon is doing well, its main competitors are doing even better. Overall, this week of big tech earnings has pushed up valuations to new records. The question now is whether those extremely high expectations are realistic. And the B word, bubble, is on everyone's mind. Sebastian Page from T. Rowe Price spoke with Yahoo Finance's Josh Lipton and shared his take.
We're neutral between growth and value stocks. We like big tech stocks for the long run. You know, listening to all these earnings results and seeing some stocks not react that much, I kind of wonder philosophically, if everyone expects a positive surprise, is it still a surprise? We have the tyranny of high expectations here. Josh, I had a mentor once told me, reality, happiness equals reality minus expectations. We had 13% year-over-year growth in Q1 in earnings, and we're beating 80% on sales so far. The long-run average is 64%. Those are good earnings. Let's forget about all the gloom and doom about tariffs and the Fed. They matter, but these are strong earnings and they're sustaining markets.
Let me ask you, Sebastian, I've been talking to you for a while now on the show, and when you come on, it's been, and correct me if I'm mischaracterizing, but it's been sort of there's tailwinds, you argue, but there's headwinds, and so you've been sort of neutral risk assets. And yet we see this melt up in the stock market. What do you make of that, Sebastian?
You know, here's the trade-off right now. The fundamentals are good, and they're better than you might think if you focus day-to-day on the financial media. You have growth expectations that are inflecting back up. You have fiscal spending coming in. As we just said, you have strong earnings. You have AI spending. It's expected to grow by 80% globally year over year. So you had the DeepSeek moment, and the big tech companies just said, hold my beer. We're going all into AI. So the fundamentals are good. The fundamentals are good from a macro perspective. And you know, what worries me, what worries our asset allocation committee is those valuation levels. It's kind of this agreement.
We're looking stretched.
We're looking stretched. 22 price earnings ratio is often quoted. It's not a really good short-term indicator. But then you have Goldman Sachs speculative trading index, all-time high. You have high risk, high beta, low quality stocks outperforming high quality stocks. last quarter, pretty much by as most as they've ever done since 1991. So you're starting to see speculation. The meme stocks are back. Crypto's rallying. Now, I don't want to sound like I'm calling for a bubble, but I'm going to say in our asset allocation committee, we're starting to use the B word and discuss, are we in the run-up to a valuation bubble? Stocks are up 30% in 3.5 months.
Yeah.
So that's the trade-off, Josh. Fundamentals probably better than the narratives around tariffs and the Fed being too restrictive. Financial conditions are loose, but the valuations are way up there right now.
For our call of the day, we're going to take a closer look at big energy. Chevron and Exxon have just reported in the past hour or so. Chevron outperformed expectations and raised its cash flow outlook after boosting oil production to a record. But it warned that crude prices are in danger of falling in coming months. Adjusted second quarter profit of $1.77 a share was 6 cents higher than the median forecast, although Chevron reduced share buybacks for the period by 1/3. The company said it remains on track to meet its annual target with as much as $15 billion in repurchases. The results come just 2 weeks after Chevron defeated an arbitration challenge by rival Exxon that had delayed the $53 billion takeover of Hess Corporation for more than a year. Moving on to Exxon now, and it posted better than expected results after robust oil production from the Permian Basin and Guyana cushioned the impact of lower crude prices. Adjusted second quarter profit of $1.64 a share was 8 cents higher than the median forecast. Exxon maintained share buybacks at $20 billion a year, reassuring investors increasingly concerned about big oil's capacity to sustain shareholder returns amid weak commodity prices. The quarter was marked by wild swings in oil prices as US President Donald Trump's trade war and OPEC Plus output increases confounded supply and demand outlooks. International crude prices were almost $20 a barrel lower during the period on a year-over-year basis, forcing several US producers to slow output growth. But Exxon sees no reason to stop growing in US shale. Okay, it's time for us to go now. We haven't got time to look at. Let's have a quick look at the markets, actually, if we can. And the US futures are not looking very good today. They're all in the red. Asian markets all in the red as well, and Europe in the red. That's not really a big surprise. All eyes will be now focused on what the jobs report will say at 8:30 Eastern. Okay, that's it for Market Sunrise for this morning. Stay with Yahoo Finance for continuing live coverage of the markets and your money all day on streaming and online. At 9 a.m. Eastern, join Julie Hyman ahead of the market open on Morning Brief. I'm Ramzan Karmali. You've been watching Market Sunrise. Go own the morning.